So my name is Dr. Erasmus. I am the convener of the postgraduate diploma in transfer pricing through Middlesex University in London. So today I'm focusing on two aspects that are really important when it comes to any type of tax issue, but more particularly we're talking about transfer pricing, and that is tax risk management and dispute resolution, and in particular how it impacts and affects transfer pricing. Ultimately, this all culminates at some point into what is tax risk management and ultimately may end up being in a dispute resolution process. Now, my career for the last 30 odd years has focused significantly on tax dispute resolution, and in the last decade or less than a decade has focused significantly on dispute resolution mechanisms and processes involving transfer pricing and other related international tax principles. What I do is I act as counsel, independent tax counsel, arguing these cases in many different jurisdictions. And as a starting point, what is extremely important when it comes to dispute resolution is the whole issue of tax risk management, and obtain a copy of a book that I wrote some years ago, and I would strongly recommend that you please download a copy. It's a book that is written around an extensive series of tax risk management processes that I designed and implemented for some very large multinational corporations some years ago, where many people have based their tax risk management processes in large corporations on these principles. And the principles are really set out in 7 key points, which I'm going to take you through briefly and highlight elements of those that are very important, and more particularly so when it comes to something complicated such as transfer pricing. And these 7 bullet points listed here, and I'm going to go to the actual text of the book that I wrote and bring that within the screen for you to take a look at. And what we're going to look at is, and I'm not going to go through the whole book, I'm just going to basically take you through the contents table. The first chapter and the first really element that you need to make sure of in implementing a tax risk management plan towards dispute resolution management processes is don't be reactive, but be proactive. And what is meant by that? Now, clearly in transfer pricing, it requires a tremendous amount of annual preparation and planning, constantly looking at the current transfer pricing issues within a group context and adapting them on an annual basis at the very least, and adjusting the transfer pricing reports that have been compiled to ensure that there is ongoing compliance in what is a rapidly changing arena. Now, that goes without saying, but at the same time, don't underestimate the effect that this may have on other areas of taxation. And so we have seen that transfer pricing issues oftentimes give rise to secondary tax issues, whether it be adjustments to dividends tax, whether it be a VAT implication. There are many other secondary tax issues that may emanate from a transfer pricing adjustment that needs to be put into play. And the rules are different in various jurisdictions. So for instance, in Europe, there are a variety of VAT directives, and the issue of a particular VAT adjustment being made, if there has been a transfer pricing adjustment, the writing that is available at the moment seems to indicate in most of those jurisdictions, unless there is an absolutely direct correlation or link between the transfer pricing adjustment and a VATable transaction, to really put it in very broad generic terms, that there would typically not be a VAT adjustment. Again, one would need to look at the specific directives, not just from a European perspective, but how they're being applied by each individual European Union country to ensure that you're not running foul of making a VAT adjustment if it's necessary. But let's take that concept and throw it into the African jurisdiction. And a very recent case that I was involved in pertains to a VAT adjustment that the Kenyan revenue authorities were attempting to impose on a transfer pricing adjustment, voluntary transfer pricing adjustment made by a large corporation. And having looked carefully at their VAT legislation, as well as then, from a broad perspective, looking at how the European Union and the VAT directives there deal with it, those directives, of course, have no application in the African context. And there was potentially, by virtue of the very broad wording in the VAT Act of Kenya, there was a potential concern that a VAT adjustment could in fact be applicable. It so turned out in that particular instance it wasn't the case, but it did require a very careful look at it. So here, when we say don't be reactive, be proactive, you constantly need to look into potential concentric rings that emanate from your transfer pricing adjustments that you are required to make on an ongoing basis. And you need to be acutely aware of how various jurisdictions that you're operating in may react to these secondary tax adjustments, as well as the way in which they're looking at transfer pricing issues. It goes without saying that in the current environment, where COVID-19 has caused a tremendous impact from an economic perspective worldwide and to each individual country, these revenue authorities are more desperate now than ever to pursue tax collections. And what we have seen, again, from an African perspective, and I have no doubt that this is going to emanate in all jurisdictions, including all the emerging economies around the world, is that there's going to be a concentration on those areas where they believe that they can generate more revenue than anywhere else, and transfer pricing is one of those areas. And they're going to push for conclusions and assessments and revised assessments as quickly and as effectively as possible in order to maximize the opportunity for them to be able to collect this additional revenue. And what we're seeing is a lot of shortcuts are being taken. So you need to be proactive. You need to be aware of what's going on in these various jurisdictions so that you can plan around these. And this sort of leads into the next point. You cannot do this on your own. You cannot, many large corporations have extremely small tax departments, some better than others, but many that I've seen and worked with have very small tax departments that are under huge pressure to adhere to compliance principles and to just ensure that they're being compliant. They're just getting their tax returns and different notifications in, and there's very little time left to be proactive. And that is why it is essential that you as a group of companies create a tax team. Now, that tax team cannot just comprise of your internal advisors, who, as I've said to you, are oftentimes limited. You need to pull in, and inevitably you will have a large accounting firm that has a tax department that assists you with the compliance work. You need to get one or two of those people involved, not necessarily the audit side. I'm not talking specifically more about the consultant side. You don't necessarily want the auditors to be part of what I'm now going to promote, and that is your tax risk committee. because you are identifying potential problems, and you don't want them now to identify those as something that must come out in an audit report, because that has a whole range of repercussions. And this may very well be premature because you haven't had an opportunity to determine to what extent there is an exposure and how you're going to deal with it. But if you've got your tax advisory team sitting on this tax risk committee, and I would propose it would meet every 3 months to review what is going on. And it's very important that those meetings take place in an attorney-client privileged environment. So in my particular instance, because I'm a practicing attorney, I'm able to come in as the chairperson of that committee, and inevitably we're looking at dispute resolution orientated issues. And so whatever is discussed in committee becomes subject to attorney-client privilege, because I'm the chairperson, or another lawyer who's knowledgeable in that area is the chairperson, and it becomes sort of an advisory discussion place where you cannot be forced, except in a very few limited jurisdictions, one of them being China, where they don't have the attorney-client or legal privilege principle that applies. But in most countries, the legal principle or the privilege principle applies. These issues can be debated openly amongst these different parties that can give input and identify and help steer the way clear to working out how to strategize around some of these problems. And that segues into, it's very important to develop a tax risk management strategy. And once again, if you go into this particular chapter, it will give you some very interesting practical ways to go about doing this. And then apart from that, the next item is don't be insular, become transparent. And this goes back into being able to encourage your different subsidiaries, operating companies around the world, the moment that a potential problem arises, that they need to bring it to the attention of your tax team at head office or at the shared service center, and that particular issue is then able to be discussed in these tax risk committee meetings in order to help identify potential solutions in going forward. Which comes to the next point of oftentimes we find that people tend to focus on the principles of taxation and do not spend a lot of time on gathering the facts around what has gone wrong or what seems to be going wrong. And the more facts that you have, the more capabilities you have of being able to find a potential solution in bringing down the tax risk exposure in a particular area. Those of you working within these large corporate environments, again, because you're constantly under pressure to meet compliance deadlines, don't have the opportunity to delve into the facts and obtain more facts about a particular problem. And I'm going to illustrate with one or two examples to give you an idea of what I mean by this. And in that way, you then miss opportunities in circumventing a particular exposure, particularly where these revenue authorities are overeager. Most of you will have internal audit divisions. We're not talking about external auditors, but internal audit divisions. Again, they need to skill themselves up to be able, as an independent testing entity, to go in and to be able to identify potential risks. So if as a double checking point, you're wanting the tax compliance managers in your various operating companies to come forward with problems, but you want your internal audit team to be able to identify what some of those potential risks may be in order to, trigger certain areas so that you've got feedback from a different source as to what might be going wrong in the broader group context, particularly from a transfer pricing point of view. And then finally, the importance of communication. And that, again, goes back into what I've just said. communication circulating within the group, coming back into the tax risk committee, where it can then be discussed under an attorney-client privileged basis. Now, so all of this culminates ultimately, into what I've experienced in my career, and I mentioned I've been doing this for a very, very long time. In my career, we have sort of now got to a point in representing large corporate groups. I've now dealt with in excess of $4 billion worth of tax dispute amounts. So varying amounts, but if I were to add it up and convert it into US dollars, it would be in excess of 4 billion. And by virtue of implementing these strategies, those clients on average have had to face a tax bill of less than 3% of that 4 billion potential exposure. That's a significant number, and that's a very significant success factor. And most of those exposures were ratcheted down by virtue of effective tax risk management principles and not having to go to court. Now, some of you will say, well, that sounds great. I mean, that 4 billion amount, it's easy. You would have identified an exposure through this tax risk management process. No, I'm talking about $4 billion worth of tax exposure raised by virtue of assessments or near assessments or letters of findings on conclusions of audits. These were amounts of money identified by revenue authorities wanting and seeking to collect those sums of money from these taxpayers. As I said, less than 3% ended up being paid out. And how is that possible? So herein comes the example. And so what's extremely important by being proactive and by being involved and by obtaining more facts and having an excellent line of communication with the various operating companies. How do these exposures start? Well, firstly, the planning and compliance side. You've learned these principles and you've gone over them over the last months. Of course, you want to make sure that all of that has been done correctly and accurately, and it's constantly being tested. But there comes a time when a revenue authority decides to conduct an audit and they're going to disagree with whatever your findings are. Whatever you've decided or obtained, advice that you've obtained, they're going to take a different point of view and they're going to not agree with you. And ultimately that gets driven to a point where an assessment is raised, and in some jurisdictions, they don't even have to win the case. What happens is when they raise the assessment and you want to now raise an objection in order to go the proper formal tax dispute resolution process, you have to fork out a sum of money. Sometimes it's 25%, sometimes it's 33%, sometimes it's 50%. In the more developed countries, they don't have this process. For instance, in America, that's not the case. You don't have to pay now or pay anything now. You can go to court, and it's only once you've lost the matter in court that you have to fork out an amount of money, plus interest, of course. But in many other jurisdictions, you literally have to make a payment before you can advance the matter. And that oftentimes works against the taxpayer, either because the economy that you're fighting the matter in is subject to a very high rate of inflation. So by the time you are sitting in court 6 years later, the millions of whatever currency that they've now taken away from you and that you're going to get hopefully refunded on has devalued to such an extent that it ends up really not making any difference. A classic example is Zimbabwe. You can imagine, I've been in cases where assessments were raised in US dollars when Zimbabwe was based on the US dollar for a period of time. Then they converted all the US dollars into their funny money currency again, and inflation is sitting at 1,000%. So if you're now seeking some kind of a refund based on an American dollar amount going back 6-7 years, once you convert it into their funny money currency, it's worth nothing. It's really not even worth pursuing. I mean, that's sometimes what happens. And so you're wanting to eliminate that initial exposure that I've just spoken about. And the opportunity for that through this tax risk management process comes in at the time of the audit. And the only way that you can take advantage of that is to be on top of what I say, the admin law principles. And many of the principles that I've applied in obtaining the success rate that I have was based on an extensive PhD that I wrote on administrative and constitutional principles applicable to tax in the South African environment. Right, so that's specific to a country, but for those of you who've done broader reading and you were introduced to constitutional and admin law principles, you will recall that the Constitution of South Africa is one of the newest constitutions in the world, based on the American Constitution, the Canadian, and various other constitutions, and is a well-written, well-heeled, some great case laws emanated from interpreting some of the principles. So it's a good reference point. The important thing is the principles that emerge out of my PhD are universally applicable with adjustments to many, many other jurisdictions. And really the key aspect of it is particularly in this environment where revenue authorities are racing to issue revised assessments. Many times we find that they take shortcuts and they do not procedurally comply with what the law requires them to do. And there, when we talk about the law, we're talking about either the taxation provisions in the form of an Income Tax Act or a VAT Act, whatever the case may be, and or a tax administration or an administration act that is applicable. And there are hard and fast rules that these revenue authorities must comply with. And if they do not, the ultimate conclusion which they reach, and that is the assessment we're talking about, could and is in many instances unlawfully issued and not worth the paper it's written on. And the effect of that is if you have scrutinized and participated in the audit process properly and scrutinized every single move of the revenue authority and logged everything that they've done wrong and challenged them on everything that they've done wrong procedurally and not just from a technical point of view, you're going to end up tying them up in a process whereby ultimately, and I refer to a SARS judgment where there was a groundbreaking judgment that I argued a couple of years back, where when we got to the tax court, we did not even have to argue the principles of taxation. All we needed to do in addressing the court was to show that the revenue authority had flagrantly, completely disregarded key procedural steps in raising the revised assessment. And on that basis alone, the assessment was set aside. Now, you may say, well, so what? So now the assessment is set aside because they didn't follow the correct procedures. They'll just go back and fix it. Sure, but in all jurisdictions that I know of, there's a prescription period. They only have so many years within which to fix the mistake. In South Africa, that's 3 years. In many jurisdictions, it's also 3 years. It might be 6 years. But look how long it oftentimes takes to get a case to court. By the time the case is in court, it's too late for that revenue authority to fix that procedural mistake. And on that basis, the judgment against the revenue authority was won 100% without even going into the tax principles. And we've seen this process emerge in many of the cases that I've dealt with over the years that never ended up going to court because we were able to then deal with the legal departments of the revenue authority to say, guys, you know what, you're so far off the mark in terms of what you've done procedurally. It's so wrong that a court's never going to entertain what you've done. So, and at times they've backed off or attempted then to re-enter the audit process and to fix what they've done, oftentimes finding that it's now too late. So, coming back to the whole tax risk management process, you cannot just flagrantly disregard the audit process. It is absolutely essential that you are engaged with these revenue authorities and that you police them and that you make sure in most instances, whilst they are now entering into the audit process, they're constantly issuing you with new requirements for information. And what happens is you respond and you send them more information. And typically, you'll oftentimes find that they ignore that information and they ask more questions. Well, you need to take them back to that correspondence. You say, but hold on, we've sent you all of this. We've given you explanations. Please, can you tell us why the explanations and the information that we've given you doesn't satisfy what you are looking for? And oftentimes, their dissatisfaction will be their standard of proof is completely contrary to what the standard of proof is in a court of law. And once again, I'm being very generalistic, but when we're dealing with court cases in the tax environment, we're typically dealing with the balance of probability evidentiary rule. We're not talking about beyond a reasonable doubt, which is the test that's applied in criminal law. The balance of probability rule says, which version is more probable, their version or our version? And we're looking at the tilting of the scales of justice. And literally our version just needs to be a little bit more convincing than their version. But when it comes to the audit process, they will delve into records and they want to see original source documentation, and they're not satisfied because you haven't provided them with sufficient proof, and they simply ignore the fact that there's been a proper audit by an independent audit firm, and the fact that the records might no longer be available because they're going back more than a 5 or 6 year period, and you're no longer required to retain those records, and now you're having to compile records from information that's broadly available in terms of audit reports or whatever the case may be. You need to identify and set out those explanations in a very detailed manner and address them on it, because all of that will emerge at the point that they now pull that trigger and issue an assessment. And they've now taken the standard of proof way beyond what the courts would consider to be viable proof under the circumstances. All of that goes to show that they have conducted themselves procedurally in an unreasonable, unlawful, or unfair manner. And those words, unreasonable, unfair, and unlawful typically means they've acted outside the scope of their powers, which again is aligned with unfair and unreasonable. All of that is potentially ammunition to address them specifically on the fact that their conduct in issuing the assessment is unlawful, and as I said, unreasonable or unfair. And if I were to use the South African Constitution as an example, the moment that you're able to show that, then that conduct becomes invalid conduct. It's invalid, which means that which then pursues or comes after that invalid conduct, which is the assessment, also then becomes invalid. And that, I'm afraid to say, is not an automatic process. If you do nothing about that and you simply just go the distance and you ignore all of those indiscretions and you simply now address the technical difficulties in your objections in preparing to go to tax court, and you don't raise those as grounds of objections or grounds for the dispute, you will not be able to raise that in argument once you get to court. And so my experience is oftentimes many of you who deal with these principles come from an accounting background, and that's just because you're trained technically in these areas far better than what a lawyer is. But there are lawyers such as myself that have received similar training to you, but also have married these tax and administrative and constitutional principles and abilities to raise these arguments. And the large accounting firms tend to gloss over this stuff and not do much about it. And as I say, once you get to court, you're unable to raise, or once you get initiating even the objection stage, this is completely left out of the equation, and the opportunity to get wins early on in these dispute moments that arise in these complex matters is lost. So you either use it or you lose it. And if you don't use these principles, you end up losing them. And there's no way to go back. You'll have to then consider doing it in the future, in some future scenario where this might happen. And so in working towards the preparation for the trial, all of these tiny little snippets are so important in preparing for these matters. I mean, I'm not here to talk to you about all the technical principles that you've worked through and how you can show them in your arguments on paper that they're wrong and they've taken into account wrong aspects of the OECD guidelines, or whatever the case may be. All of that can now be supplemented by a very powerful attack on their inability to comply procedurally with what they are supposed to do, and what they're supposed to do that is fair, reasonable, and ultimately lawful. And so therein lies a massive opportunity. And so going back into the tax risk management process, it is essential, by virtue of the communication and being more transparent with everybody throughout the group and creating the tax risk management committee, that your people out there that are at the coalface, that are receiving these questionnaires and interrogations from revenue authorities, immediately make all of that information available to your central point of collection, so that you have the opportunity to oversee this and identify areas where not only the revenue authorities are technically going in the wrong direction, but in terms of the manner in which they are conducting themselves in doing so. Because the two married together will increase the opportunity for you to ratchet down significantly the tax risk management exposure that you have, by virtue of ensuring that they are doing what they should be doing correctly. And again, I emphasize the point. They love jumping to conclusions, and oftentimes without any substantiating expert evidence, or without even having hired an expert transfer pricing specialist to come and criticize your methodology. They simply reject what you're putting to them, and every single time they do that, and you have the opportunity to explain back to them and then ask them on what basis have they reached this negative conclusion. And the moment they now pushing the principles of evidence beyond the scope of what is applicable in a court of law, you now are creating an opportunity to trip them up, ultimately in the assessments that they arrive at. And so I really want you to reflect on that very carefully. And as I said, going back to my track record in being involved in over $4 billion worth of tax disputes, and on average clients having to pay out less than 3%, these principles have been thoroughly applied. Some of the clients have implemented the tax risk management strategies and have ongoing 3-monthly meetings to review these things, and their tax risk management review process turns out to be exceptional. And as much as there is an identification of tax risk, and there will always be tax risk, you can never eliminate it, they ratchet it down all the time, but they are ultra sensitive to every single audit that takes place. And at the moment that audit starts, you want to be in a place of scrutiny, scrutinizing exactly, challenging the revenue authorities on every single item that they're looking to look at. And that even starts with the scope of the audit. Sometimes the scope of the audit is just so unbelievably broad that you need to then write back to them and say, right, we understand, but what are your specific issues here? Could you please address us on specifically what areas of concern you have identified? And oftentimes that will be met with a letter that's a little bit more focused on a particular area. And indirectly, what is happening is that you are indirectly taking control of that audit process and teeing yourself up to monitor their movements and ultimately get to a place that I hope I've demonstrated to you.